In our previous video, we saw how difficult it can be to get an accurate number for inventory, especially with things like goods in transit or consignment goods or any other variety of issues, even as it relates to cost flow assumptions, right? Sometimes it's easy to make errors. So in this video, we'll just briefly discuss some concepts around inventory errors and then do an example to see the impact of inventory errors. So when thinking about inventory errors, it's actually very important to bear in mind that there is a relationship that exists between all the elements that make up inventory. So I am on page 2 of your handout and I'm looking at inventory relationship specifically as it relates to the periodic system. Here we see that beginning inventory plus all the purchases, right, cost of goods purchased, gives us all the cost of goods available for sale. You may also remember this from when we were calculating LIFO, FIFO, and average cost. Whatever we started with plus what we bought gives us everything that we could sell. And then the cost of goods available for sale minus whatever is left over tells us what our cost of goods sold is for the year. So this relationship is crucial to understand because if we do have errors in inventory, they may take place in the cost of goods purchased, in other words, the purchases. There may be a mistake in ending inventory, and the ending inventory of one year becomes the beginning inventory of another year. So there are all types of knock-on effects. Remember that cost of goods sold is an expense which goes to the income statement. So a mistake in a cost of goods sold will impact the income statement, thereby impacting net income or net loss, which, if you recall from previous accounting classes, net income or net loss is closed out to retained earnings. So a mistaken cost of goods sold can definitely end up having an impact on retained earnings. Mistakes in ending inventory will cause problems on the balance sheet because ending inventory is the number that shows up on the balance sheet. So that will also cause some issues in our financial statements. If we scroll down here on the handout, we'll see that there's actually a section for inventory errors. And this is on page 3. So yeah, items incorrectly included or excluded in determining costs of goods sold through inventory misstatements will result in errors in the financial statements. So we are assuming a periodic inventory system here. That means that the company is not updating its records as it buys and sells inventory to account for cost of goods sold. It is actually just recording purchases as it goes along, and at the end of the year, it will calculate cost of goods sold, just like what we were doing up here, what we were demonstrating up here. So looking at the ending inventory misstatements, right? What this example is saying is a company correctly records its beginning inventory and purchases, but excludes some items from ending inventory. So ending inventory is understated, which means that it's too low. If that's the case, then on the balance sheet, we are going to have problems in inventory because inventory balance will also be understated. And then because ending inventory is subtracted from cost of goods available for sale to get to cost of goods sold, if ending inventory is too low, it means that cost of goods sold is too high, which then also means that net income will be too low because there's an inverse relationship between cost of goods sold and net income. So again, if ending inventory is too low, our cost of goods sold will be too high and our net income will be too low, which then also results in our retained earnings being too low because remember, net income goes or flows into retained earnings. So here's the explanation for the income statement. When this happens, that ending inventory is understated, cost of goods sold is over, it's too high, and net income is under. And here's a helpful little chart to explain to us how these things work, right? If beginning inventory is understated, what happens to cost of goods sold and net income? If it's overstated, and then ending inventory and so on. You can spend some time and look at this. I don't expect you to necessarily be memorizing this table, but you should understand the relationship between these elements because it helps to explain how an inventory error can affect the financial statements. So if you're working as an accountant and you find out that there was an error, you need to understand how to be able to correct it. It's also possible for a company to make mistakes in its purchases amounts if it's using the periodic system, and also that can cause problems on the financial statements, right? So in the scenario, company does not record a purchase, so it's a purchase on account and of certain goods that it owns, and it also doesn't count them in ending inventory. So this should probably be purchases and ending inventory misstated, right? So purchases doesn't include the amount, and neither does the ending inventory. So inventory on the balance sheet is going to be understated because the amount was not included in ending inventory. Accounts payable is understated because something was bought on account and yet it was not recorded in the journal entry, so it doesn't flow to the financial statements. And then for the income statement, both purchases and ending inventory are understated, which means that the mistakes cancel each other out, so there's no impact on cost of goods sold and net income. What that means is because we didn't include something in purchases, it was like it wasn't available to be sold, and it wasn't included in ending inventory, so there really is no impact. That's why there's also no effect on retained earnings. And of course, the opposite is true if we had to overstate purchases or overstate ending inventory. Look, these concepts are not going to necessarily just make sense immediately. You have to read them over a few times and think about them, because you kind of have to know how things work if everything was correct in order to figure out how a mistake would impact the financial statements. So keep going back to this relationship that we spoke about before and try to figure out the impact of the errors in light of that relationship. Now we'll switch gears a little bit and actually go to an example of this phenomenon. And so I'll just scroll down and look for the question, which seems to not be here, so I'll have to find the question in our practice problems. Okay, so the question that I wanted us to pay attention to was this example 3, and this example is in your handout and it's on page 13. So in this example, we have Rolex Watch Company reporting the following income statement data for a 2-year period. So they have sales, they have cost of goods sold, calculation, 2 years, all the stuff that impacts cost of goods sold, tells us that the cost of goods sold number is 161 for 2013 and 194 for 2014. And then we also have a gross profit of 59,000 and 56,000 respectively. Rolex uses a periodic inventory system, which means it uses that relationship between inventory and purchases to get to cost of goods sold. The inventory is at January 1st, 2013, which means the beginning inventory over year, and December 31st, 2014, so that's this ending inventory, are correct. However, the ending inventory at December 31 was 2013 was overstated 6,000, so there was a mistake. And we are asked in A to prepare the correct income statement data for the 2 years. We are asked what's the cumulative, in other words, the overall effect of the inventory error on total gross profit for the 2 years. We'll be able to tell by looking at our work in A, and then also completing the following sentences, which we can come back to. That looks like asking us about the relationships between errors and what that does to cost of goods sold and net income and so on. Okay, so find a clean page or a book or something where you can write, and let's go ahead and prepare this income statement for 2013 and 2014. So I'm working off of what we were given in the handouts, and then obviously we are going to fix that error that exists. So we start off the same as in the question. We have sales, and the sales for 2013 are 220,000, and for 2014 is 250,000. And then we have to do our cost of goods sold calculation. So this is kind of like a heading, right? This cost of goods sold. And then we have beginning, oops, too many ends, beginning inventory. And that is for the sake of 2013 going to be 32,000. Let's stick with 2013 for the meanwhile, because we know that there's a mistake that we need to fix, so let's not try to complete 2013 and 2014 at the same time. Then we've got costs of goods purchased, which is the same as purchases, and that, based on the question, is 173,000. That number was given. And that those numbers together is what gives us cost of goods available for sale. So we add these two, that gives us 205. So this is going to be cost of goods available for sale. And then we have this ending inventory, which gets subtracted from cost of goods available for sale. So this ending inventory was overstated by 6,000, which means it's too high by 6,000. So we need to say 44,000 minus 6,000 is going to give us 38,000. That's the amount that should have been included in ending inventory. So now we want to figure out what our cost of goods sold amount is going to be. So put a line over there and you say cost of goods available for sale minus ending inventory is cost of goods sold. So instead of the 161 that we had previously, we now have 167. And then we have gross profit, and the way we calculate that is to say sales minus cost of goods sold. So gross profit is 53,000. That is also where this income statement ends. So even though this is not net income, I'll just draw a double underline to show that we are done. So now the trick is that the ending inventory of 2013 represents the beginning inventory of 2014. So you can see that previously that wrong number, 44,000, was in ending inventory of 2013 and beginning inventory of 2014. So now instead of 44,000, we need to put 38,000 into our inventory number so that we can actually have the correct number. Everything else stays the same. We have 202,000 as our purchases as per the question, and we're going to add these two numbers together to get our goods available for sale. We were told by the question that the ending inventory of 2014 was correct, so no changes needed there. So now we're going to say cost of goods available for sale minus ending inventory gives us cost of goods sold. Notice how it's $1,000 lower because our ending inventory is the same, but our beginning inventory is smaller than before. So we've got this new number of 188,000, and then for cost of goods sold, which then means that our gross profit, 250 minus 188, is going to be $6,000 higher. So this is how that mistake in ending inventory over here is going to impact everything going forward. So what we realize is that when a company is making a mistake at the end of 1 year, they have to be very careful because that mistake carries on potentially into the next year. So looking at B now, it says, what is the cumulative effect of the inventory error on total gross profit for the 2 years? Well, let's see, right? What was the gross profit when we had the incorrect numbers? So incorrect gross profit, we had, if you recall, we had 59,000 from the question plus 56,000, and together that is going to equal 115,000. And then when we look at the correct gross profit based on the new numbers that we calculated, we have 53,000 plus 62,000, and look at that, right? We end up with the same cumulative gross profit amount. And the reason for that, as you may have noticed, is that the mistake in this year causes our gross profit to be lower, 53,000 versus 59, but then it swaps around in the next year, so our gross profit becomes higher. So if, for instance, if the company only discovers the error in year 2, it actually means that the error would have reversed itself. But what we have to be careful about is if this error is actually material, meaning that it could change someone's mind about the financial statements, then the company may have to go back and correct everything, even though the error fixes itself in the second year. But here is an important point, or maybe two important points. One, an error in ending inventory in 2013 impacts beginning inventory in 2014. And two is that if we have an error in year 1, by the end of year 2, the error would have reversed so that we actually cumulatively have no impact on our net income, or in this case, our gross profit. So let's go back to C in this question, part C, and try to understand what is being asked of us, right? It says complete the following sentences. If ending inventory is overstated, meaning it's too high, cost of goods sold will be, and I'll fill it out for us over here, cost of goods sold will be understated. The reason is that we go back to this relationship over here. If you'll just bear with me for a minute, I'll scroll up and we can see the relationship, right? Cost of goods sold is the number that we get at the end. If ending inventory is too high, then it means because we subtract ending inventory from cost of goods available for sale to get to cost of goods sold, if this number is too high, then this number is going to be too low. And what happens to net income when cost of goods sold is understated? Well, cost of goods sold is an expense, so expenses are lower. That means income is going to be higher. So net income will actually be overstated when cost of goods sold is understated. Now, if ending inventory is understated, we are just going to take the opposite approach, right? Then it means that cost of goods sold is going to be overstated, and since that expense is overstated, net income will be understated. Moving on to the next bullet, if beginning inventory, so this is interesting now, right? We're dealing with beginning inventory. So if beginning inventory is overstated, well, let's see where beginning inventory stands in this relationship. Beginning inventory is over here. So if beginning inventory is too high, it's not being subtracted. So if this is too high, it probably means that cost of goods sold is going to be too high as well, because we are saying that we had more items to sell than what we actually did. So if beginning inventory is overstated, then cost of goods sold will also be overstated. And if expenses are too high, then it means that net income will be understated. And then if beginning inventory is too low, we'll end up with a cost of goods sold that is too low, and net income will be too high. So another way of thinking about this is, do you see this minus sign in front of ending inventory? This minus sign means that cost of goods sold and ending inventory move in opposite directions. So if ending inventory is too high, cost of goods sold is too low. If ending inventory is too low, cost of goods sold is too high. There is no minus sign in front of beginning inventory. That means that beginning inventory and cost of goods sold move in the same direction. So if beginning inventory is too high, cost of goods sold is too high. If beginning inventory is too low, cost of goods sold is too low. So this then concludes our work on inventory errors, and you can go ahead now and attempt some of your questions.